Hello everyone. In the previous class, we talked about capital and revenue expenditures. We also attempted 29 MCQs related to capital and revenue expenditures. In today's class, we are going to talk about depreciation. Depreciation is in fact one of the very important major topics of O-level accounting and IGCSE accounting. In fact, this topic is related to non-current assets. You know that there are two types of the assets. One are called current assets, while the other are called non-current assets. So this is related to non-current assets. Let's see the definition of non-current assets first. Non-current assets are if you have bought an asset with an intention to use it into the business, and secondly, the estimated life is more than a year. If both of these conditions are fulfilled, the one is that you bought it with an intention to use into the business, not for resale, and secondly, the estimated life is greater than a year. This is your non-current asset. Okay, I write it down here too. Bought with an intention to use into the business for business use. Okay, and second condition is that it should have a life greater than 1 year. 1 year. Okay, so this is called non-current asset. So for example, your plant and machinery, for example, your furniture and fixtures, vehicles, etc. Okay, so this topic is related to these assets. Building is also one of the examples. So first of all, let's see the definition of depreciation. We understand the definition of depreciation with the help of an example. Let's assume that you bought a machine at a price of $7,000. Okay, you bought it. The purchase price is, let's suppose, $7,000, and after that you incurred some more expenses to bring this plant and machinery to its business location, and to bring it into the workable condition. Let's suppose these are some further cost. Okay, so altogether this is $10,000. This is called cost of machinery. Okay. If I assume that the estimated life is 10 years, if the estimated life is 10 years, then that means every year, and after that, after completing its life, it will become zero. The scrap value will be zero. So we may say that every year the asset is losing $1,000. The value which is decreasing every year is $1,000, and after 10 years, the whole of the asset will be expensed out. Means that this 1,000 is in fact, this is called depreciation. Okay, the cost of the machinery was $10,000, and we estimate that the life is 10 years. So every year it is losing its value by an amount of $1,000, and after 10 years it will be zero. So this 1,000 is called depreciation expense in accounting. Okay, this is depreciation. You may see that in the first year it will lose 1,000. In the second year it will lose another 1,000. In the third year it will lose another 1,000. So after 10 years it will lose all of its value. Okay, total value of $10,000. So this is in fact depreciation. Now we see the formal definition of depreciation. Depreciation is that part of the cost of a non-current asset which is consumed during the period of its use by the business. For example, for a year, this is $1,000. Why? Because you have get a benefit of $1,000 in 1 year, and in 10 years you have got and obtained all the benefits from this plant and machinery. So every year you are getting a benefit of 1,000, and so that's why you are charging the cost of $1,000. Okay, so this is called depreciation, and this is the definition of depreciation. Now we move towards the methods of depreciation. Now we are going to see that how many methods are there for charging depreciation. In fact, in your O-level syllabus, there are 3 methods included. Number one is called straight line method. Second one is called reducing or diminishing balance method, and the third one is called revaluation method. This is also called SLM, straight line method. Okay, so now let's understand what is straight line method. Let's suppose you buy a machine and the cost of the machine is, let's suppose, $10,000. Okay, and the life is 10 years. So the annual depreciation is $1,000. Okay, for first year you charge 1,000. For second year you charge again 1,000. For third year again you charge $1,000. So you may see here you are charging, and likewise in the last, and let's suppose if the life is 10, we have already assumed that the life is 10 years. So in the last year we will also charge 1,000. So you may see that every year we are charging the same amount of depreciation. So remember that under straight line method we charge the same amount of depreciation, annual depreciation. Okay, that is why we call it straight line method. Or let's suppose I take years on my y-axis and I take annual depreciation here on y-axis. Let's suppose this is 5,000. Let's suppose this is 500. This is 1,000. So, and these are the years: 1, 2, 3, 4, 5, 6, 7, 8, etc. Okay, so you may see in the first year the annual depreciation is 1,000. In the second year it is 1,000. In the third year the annual depreciation is again, you are charging 1,000. In the fourth year again it is 1,000. In the fifth year is again 1,000. So you may see that these all, every year you are charging 1,000. This is your annual depreciation. Since it's a straight line, that's why it is called straight line method. So about straight line method, we have learned one point. The point number one, that under SLM same annual depreciation is charged every year. Okay, this is the point number one. Now we are going to see the next very important point related to SLM. Under SLM, you will either be provided with the rate of depreciation. Okay, for under SLM, if whenever a question is put on SLM, you will be provided with the percentage rate of, we may call it rate of depreciation. Rate of depreciation. And second is if the rate of depreciation is not given, then you will be provided with the rate of depreciation and cost will be given. Okay, and if rate of depreciation is not given, then cost, scrap value, and life will be given. Then you will use a formula and you will calculate the depreciation. So these are the two possibilities. Okay, if the rate of depreciation is given, you will simply apply the rate on cost and you will calculate the depreciation, annual depreciation. Okay, and here you will use the formula. And which formula? I tell you, depreciation expense is equal to cost minus scrap value divided by life. Okay, so this is the second point. You must keep in your mind that either you will be provided with the rate of depreciation, you will always apply it on cost, and or if the rate of depreciation is not given, you will be provided with cost, scrap value, and life, and you will use this formula to calculate annual depreciation. Okay, this depreciation expense is annual depreciation. Okay, annual depreciation. And the next point is apart from method, you must know the policy or basis, because you may calculate annual depreciation by using both of this concept, like applying the rate of depreciation on cost, or by using this formula. But policy is must in order to calculate depreciation for a specific year. There are two possible policies. Okay, I write down one of them one by one. Policy, or we may also call it the basis of depreciation. Number one, full year depreciation in the year of purchase. Year of purchase without giving any consideration to the number of months. Okay, and the second policy is proportional policy, and we will understand these policies while attempting the question. Okay, so first of all, let's attempt this question. You bought a machine. Let's get this concept further with the help of an example. You bought a machine at a price of $11,000 and the rate of depreciation is 10%. Date of purchase is 1st April 20x1 and year ends on December 31st. It was sold out on June 30th 20x3. Method is straight line. Basis or policy is to charge full year depreciation in the year of purchase and no depreciation in the year of sale. So as this method is very much important to know to calculate annual depreciation. Okay, so first of all we will calculate annual depreciation. How can we calculate? You may see that the method is SLM, and as under SLM either the cost, scrap value and life should be given or the rate of depreciation should be given. So here rate of depreciation is given. Since the rate of depreciation is given, so you will simply apply this rate of depreciation on cost of machine to calculate your annual depreciation. So first of all we will calculate annual depreciation. Okay, solution, annual depreciation is equal to $11,000 multiply by 10%, that is equal to $1,100. This is your annual depreciation. Okay, what about the depreciation for year 20x1? We are supposed to calculate depreciation for year 20x1 and 20x2. We should read the requirement first so that we could calculate accordingly. So here we have to calculate depreciation for 20x1 and 20x2. The annual depreciation is not required. We are required to calculate depreciation for 20x1 and 20x2. So for 20x1, let's suppose what we are supposed to do. For year 20x1 and 20x2, we will have to look at the basis or policy. We can calculate annual depreciation using the name of the method, using the method, but we can calculate depreciation for a specific year only by using the policy. Okay, so the policy is important to calculate depreciation for a specific year. How? See, the policy is to charge full year depreciation in the year of purchase and no depreciation in the year of sale. So in the year of purchase means you bought it in the year of 20x1, so you will charge full year depreciation. You will not give any consideration to the number of months. You bought it on 1st April, though we used it only for 9 months, April till December. This asset was not existing and with the business in the month of January, February and March. But the policy is to charge full year depreciation. So the whole $1,100 will be charged as a depreciation. So for 20x1, the whole amount of 1,100 will be taken as a depreciation expense. What about for 20x2? For 20x2, the asset was with the business for the whole of the year. So the whole amount of depreciation will be charged, will be taken as an expense in the income statement. Yes, the accounting treatment is this amount is taken into the income statement as an expense, where you take salaries, rent, utility bills, repair and maintenance. Over there, this item is taken. That is depreciation. Okay. For year. Okay. Now come to the point again. What about 20x3? For year 20x3, we will charge no depreciation because it was sold out in the year of 20x3. It is mentioned here. You will see it was sold out, and the policy is that we charge no depreciation in the year of sale on that asset which was sold out. While the other assets are with you, you will charge depreciation on them. But what about this asset? On this asset, you will not charge any depreciation because it is written here that in the year of sale, when it is sold out, you will not charge depreciation for that year, no matter for how many months did you use it. You used it, you may see here, 6 months from January 1st till June 30th, 20x3. You used it for 6 months, but we will not charge any depreciation on this machinery or the machinery. No depreciation at all. Okay. So this calculation is based on policy. And what about this calculation, the annual depreciation? This is based on method only. You don't have to consider the policy. Annual depreciation is calculated on the basis of the method. Just look at the method. That what is the method? The SLM method, simply apply percentage on the cost. This $1,100 is the annual depreciation. And what about 20x1? That you will have to look at the policy. The policy is charge full year depreciation in the year of purchase. So you have taken the full year depreciation for the depreciation of the 12 months. And the same is here in 20x2. You used it for the second year, you used for 12 months. So you charge it for the 12 months. But you may see here that in the year 20x1, you are charging and taking $1,100 as an expense, depreciation expense. Why? Though you did not use it for the whole of the year. You used it only for 9 months, from April 1st till December 31st. Why you are charging for the 12 months? Why you are not proportionating it? No, why? The reason is that it is mentioned in the question. The policy is clearly saying that you have to charge full year depreciation in the year of purchase. That's why we are doing so. Okay. So this is the significance of the policy. Okay. Now we are going to attempt or we'll see another example. Yes, this one. You may see here the cost of machine is there. You may see scrap value is there, life is there, rate of depreciation is not there. So we know that either we will be provided with the rate of depreciation or we will be provided with scrap value and life along with cost. If it is provided, then we can use the formula to calculate annual depreciation. I am saying again, to calculate annual depreciation, we can use this formula. When the rate is given, we can calculate the annual depreciation by applying rate of depreciation on cost. And here we can calculate annual depreciation by using this formula. The cost was $11,000, you will see. And the scrap value is estimated. Scrap value means when the asset will complete its life, then it is estimated that it may be sold out at a price of $1,000. So the depreciable value is $10,000, and if 10,000 is divided into 10 years, then $1,000 is your annual expense. But what about the policy, and what about the depreciation for specific years, which is the requirement of the question, that you have to calculate depreciation for 20x1 and 20x2. So first of all, we will calculate this annual depreciation, okay, and then after that we will calculate the depreciation for these years. And these years depreciation will be calculated after seeing the policy. The policy is again the same policy, that you charge full year depreciation in the year of purchase and no depreciation in the year of sale. That's why for the year 20x1 we are giving no consideration to the number of months, though we here you may see the same situation is here, that you have used it for only for 9 months from April till December, but we are charging full year depreciation expense. And for 20x2 full year depreciation. And what about 20x3? Since you have sold it out, and the policy is saying that you charge no depreciation in the year of sale, that's why there is no depreciation at all in the year of 20x3, though you used it for 6 months from January 1st till December 31st. Okay, it was sold out on June 30th, 20x3. Sorry, so you used it from the 1st January to June 30th, 20x3. For 6 months you have used it, but you are charging no depreciation at all because the policy is asking you to do so. Okay, so there is no depreciation. Now we get another see another example. We'll change the policy over there. Okay, okay, see here, cost of the same question is there, but I'm just changing the policy here. You may see the policy is being changed. The cost of machine is 11,000, the scrap value is 1,000, the life is 10 years. Again, you may see that these three things are given. That's why you can use the formula cost minus scrap value divided by life to calculate your annual depreciation. Okay, so you have calculated the annual depreciation here. Okay, cost minus scrap value divided by life. Every year the annual depreciation is $1,000. What about year 20x1 and 20x2 and 20x3? You are required to calculate depreciation for these 3 years. They want to know that how much is the depreciation expense which will be taken into the income statement in year 20x1, and also tell that how much will be taken in the income statement of year 20x2. And they are also asking you to calculate depreciation expense for year 20x3, which will be taken in the income statement as an expense. So you may see that we are going to calculate the specific year's depreciation using policy. Again, I'm saying using policy. What is the basis of policy? The policy is proportional. The basis is proportional, means you give consideration to number of months. Proportional means giving consideration to number of months assets was with the business. You may see here in year 20x1, okay, we have calculated the annual depreciation here. Now in year 20x1, we will calculate depreciation seeing the policy. You bought it on April 1st 20x1, that means till December 31st. These are 9 months, so you will calculate depreciation for 9 months, that is 750. In year 20x2, the asset was with us for the whole of the year. That's why the depreciation is full annual depreciation. You will record it here. And for year 20x3, since you sold it out on June 30th, that means you used it from January 1st till June 30th. That there were only 6 months. That's why depreciation will be charged for only 6 months. So the annual depreciation is 1000, and if you proportionate it 6 upon 2, you'll multiply it by 6 upon 12. The depreciation for 20x3 will be $500. Have you got it? Now example number 4. Cost of premises is $20,000 while the rate of depreciation is 10%. This premises was bought on April 1st 20x1, year ends on December 31st every year, and then after that in year 20x3 you sold it out. The method is SLM and the policy is proportional. Okay, so you know that how do we proceed. First of all, we calculate the annual depreciation. That is, we will apply rate of depreciation on cost. That is $2,000. Okay, so this is the first step. Whenever the question of depreciation is given, then what do you do? First of all, you calculate the annual depreciation, and then after that you calculate the depreciation for the specific year. And we know that for calculating depreciation for a specific year, we need to have policy, the basis, and the basis is proportional here. So let's calculate the depreciation for year 20x1 first. Okay, when the policy is proportional, that means you have to consider the number of months. Okay, you bought on April 1st in year 20x1, that's why we can say that you use it 9 months in that year. Okay, so the annual depreciation is 2000 and we are using it for 9 months, so the annual depreciation will be $1,500. Okay, if we solve it, then the answer would be $1,500. What about for year 20x2? Since we have used this machinery and this was in the ownership of the business for the whole of the year, that's why we will charge full year depreciation here. Okay, $2,000. Now what about 20x3? In the annual depreciation is again 2000. However, we sold it out in the year of 20x3 and we used it only till June 30th. So from January 1st 20x3 till June 30th 20x3, these are 6 months. So we will calculate depreciation for 6 months. Okay, this is going to be $1,000. So we can say that in year 20x1 we would charge $1,500 depreciation, while in year 20x2 it would be $2,000, while in year 20x3 when we sold it out in the month of June, so the depreciation will be $1,000. Okay, that will be the half of the total depreciation, total annual depreciation. So this is all about straight line method, and in the next class we will see the next method of depreciation, that is reducing balance method, and we will also talk about and we will learn that how to calculate depreciation using revaluation method. And after that in the next class, in the same class we will see that how do we choose the method of depreciation for different kind of assets. Thank you very much.